Welcome back to CPA Mastery. In this lesson we focus on capital gains, which occur when a taxpayer sells property for more than its adjusted basis. Capital gains are heavily tested on the regulation section of the CPA exam because they combine several important concepts including basis, amount realized, and holding period. Understanding how to calculate a capital gain and determine whether the gain is short-term or long-term is essential for solving exam questions. By the end of this lesson you should be able to calculate capital gains correctly and understand how the holding period affects the tax treatment applied to those gains. In this lesson we have three main objectives. First, we will define capital gains and understand how they arise when property is sold. Second, we will examine the relationship between the amount realized and the adjusted basis of an asset. These two numbers determine whether a gain or loss exists. Finally, we will discuss the holding period of an asset and how it determines whether a gain is classified as short-term or long-term. This classification is important because it affects the tax rate applied to the gain. A capital gain occurs when the amount realized from selling an asset exceeds the adjusted basis of that asset. Capital assets commonly include investments such as stocks, bonds, and other property held for investment purposes. When these assets increase in value and are sold, the difference between the selling price and the basis becomes the capital gain. For the CPA exam, identifying whether a gain exists is the first step before applying any additional tax rules. A capital asset is generally any property held by a taxpayer that is not specifically excluded by the tax code. Common examples include stocks, bonds, land, and other investment property. Many personal assets also qualify as capital assets. The CPA exam may test whether an item is classified as a capital asset because this determines whether capital gain rules apply. The capital gain formula is straightforward but extremely important for the CPA exam. The amount realized typically represents the selling price of the asset. Adjusted basis usually begins with the purchase price and may change due to improvements, depreciation, or other adjustments depending on the asset. When the amount realized exceeds the adjusted basis, the taxpayer recognizes a capital gain equal to the difference between those two amounts. After calculating a capital gain, the next step is determining the holding period of the asset. Assets held for 1 year or less generate short-term capital gains. These gains are generally taxed at ordinary income tax rates. Assets held longer than 1 year generate long-term capital gains, which may receive preferential tax rates. Suppose a taxpayer purchases stock for $2,000 and later sells it for $3,200. To calculate the gain, subtract the adjusted basis of $2,000 from the amount realized of $3,200. The result is a capital gain of $1,200. Consider a CPA exam-style problem where a taxpayer buys an asset for $5,000 and later sells it for $6,000. The gain equals $1,000, calculated by subtracting the basis from the selling price. After calculating the gain, the exam may then ask you to determine whether the gain is short-term or long-term. A helpful strategy for capital gain questions is to work through the problem in a consistent order. First, identify the adjusted basis of the asset. Second, determine the amount realized from the sale. Third, calculate the gain using the capital gain formula. Once the gain has been calculated, determine the holding period. Capital gains occur when the amount realized from selling an asset exceeds its adjusted basis. The capital gain formula is amount realized minus adjusted basis. Once the gain is calculated, the holding period determines whether the gain is short-term or long-term. Short-term gains are usually taxed at ordinary rates, while long-term gains may receive preferential tax rates.